Good morning, everyone. Thank you for joining us today. My name is Nirmina Istoman. I'll be your host for today's webinar on corporate tax in the UAE, step-by-step guide to calculating your tax liability. Before we dive into the session, let me provide a brief introduction to our company. ACME Group has established itself as a trusted financial solutions provider across the GCC region and Egypt. We're committed to delivering high-quality solutions tailored to the needs of various businesses across different industries. Our focus on quality and expertise has allowed us to build a long-term relationship with our clients. Our exceptional team consistently delivers value efficiently, making us the preferred service provider in the region. Now, let me introduce our esteemed speaker of today's webinar, Ms. Aditi. Ms. Aditi is a senior tax manager with over 7 years of experience in international taxation. She has been actively assisting and advising multinational clients from various industries and across border transactions and compliance with complex taxation regulations. Beyond her expertise in international taxation, she's also a qualified taxation lawyer with a postgraduate degree in finance. Her skills in client management and her niche experience in taxation litigation and assessments make her a valuable asset to our team. So now, Ms. Aditi will now start the presentation.
Hi, everybody. Good morning and welcome to today's session. So, today, my friends, we'll be talking about the contents and all the implications which we'll be covering in today's session around corporate tax filing. What are the requisites? What is required? What is mandatory? What is optional? What are the steps? How do we calculate corporate tax? So on and so forth. Now, as you can see on the screen, we've put the contents for today's session, which we shall be covering today. So today we'll be talking about the timeline as to how the concept of corporate tax filing has evolved in the UAE. We'll talk about the taxable persons in detail. We'll talk about resident persons, juridical persons, natural persons. We'll talk about the deadlines which are mandatory as per which the corporate tax return has to be filed. Also, we'll discuss about the corporate tax rates. How is the corporate tax calculated? What are the possible rates for it? We'll talk about the elections to be made, the mandatory ones, the optional ones, and most important, we'll talk about the free zone qualification. So if you're a free zone company, what steps do you have to follow or what requirements do you have to meet to get the qualifying free zone status? And to end the webinar today, we'll also talk about transfer pricing documentation, the mandatory documentation requirements, the optional documentation requirements, and how do we have to maintain these documents? Why are they important? All these aspects, my friends, we'll be covering in today's session. With that, we can move to the next slide, please. Next slide, please. All right, my friends, now let's just dive deep into today's session and start the discussion. Now, the first concept which we'll discuss today, as you can see on the screen, is the evolvement of the corporate tax filing concept in UAE. Now, my friends, why are we talking about corporate tax filing today? Now, as all of you are aware, for most of the taxpayers in UAE, the corporate tax deadline to file the return is 30th September 2025. And why is that so, my friends? The reason for that is because we are following Jan to December 2024 as the financial year or as the tax period for most of the companies and for most of the taxpayers in UAE. So that is why right now at this point of time, it is very important that we discuss about corporate tax filing. Now, as you can see on the slide, what we've done is we've tried to show the evolvement of this entire concept over the past 1.5 years. Now, my friends, what do you think today? Do you think that corporate tax came into effect in June 2023 itself, or did it have its genesis in the UAE prior to June 2023? So let me tell you, corporate tax, my friends, in UAE came into the picture in January 2022 when the Ministry of Finance first announced regarding the corporate tax law in the UAE. After this law was announced, my friends, it was first published in the official gazette in the month of October 2022. And moving forward from there, as all of us know, the most important and pivotal date in the corporate tax and the transfer pricing regulations in UAE is 1st June 2023. Why is that so? Because corporate tax became effective from 1st of June 2023. Now, my friends, what happened after that was that once corporate tax law became effective in UAE, there were several FAQs published by the FTA. There were several clarificatory as well as recommendatory guides published by the FTA. And two of the most important ones regarding the concept of corporate tax filing were the determination of taxable income guide as well as the corporate tax return guide. Now, my friends, let me tell you an insight there. Now, as we know, there is a difference between decisions and the guides which are published. What is the primal difference? So, my friends, the difference between the decisions and the guides is that the decisions are binding and enforceable by law. However, the guides which have been published by the FTA, they are recommendatory. Yes, my friends, this is something which all of us must note, and it's very important is that these guides summarize the entire concept under one leisure. Plus, they are recommendatory in nature, which means that as per the FTA, they have categorically said in the preface of all these guides that we as the FTA are given recommendations for a particular chapter in these guides. Now, if I talk about corporate tax return guide, what the FTA has given in the corporate tax return guide, they have talked about the computation of corporate tax. They have talked about the starting point from where we start the computation of corporate tax, which is the accounting net profit, which is nothing but earning before interest, tax, depreciation, and amortization. Concepts like this are covered by the corporate tax return guide. The corporate tax return guide, my friends, has also given certain clarifications regarding transfer pricing, which all of us must note at this point of time, is that this corporate tax return guide has categorically said that if our related party transactions are over 40 million, then it is mandatory that we disclose them and benchmarking is required. And if the connected person payouts or remunerations exceed 500,000, then it is mandatory that we do the benchmarking and it is mandatory that we disclose such connected person payouts in the corporate tax return. And how do we disclose these items, my friends? I'm sure many of you would have seen the corporate tax return by now and the format which is there on the MRO tax portal, my friends. So therein there are separate schedules for transfer pricing. There is a schedule for related party details. There is a schedule for connected person details. But having said that, let me tell you one important thing. As we know, though the corporate tax return guide has published these limits or thresholds for related parties as well as connected persons. However, my friends, it is very important that we take note of the fact that it is not mentioned that in any case, if the value of a related party transactions is less than 40 million, then those transactions do not have to be benchmarked. Similarly, it is not mentioned anywhere in the law that if the value of our connected person payouts, which means the salaries, remunerations which we are paying to our key managerial personnel, if the value or threshold of that is less than 500,000, they shall not be questioned by the FTA. So, my friends, it is very important that all of us note that irrespective of the quantum, irrespective of the threshold, if we have any related party transactions during our first tax period, which was January to December 2024, as well as the fact that whatever payments we are making to our key managerial personnel, which means whatever remunerations, be it the fixed, be it the variable, be it the incentives or the perquisites, which we are paying to our key managerial personnel, irrespective of the amounts, we do a detailed benchmarking analysis for the related party transactions as well as the connected person transactions because, my friends, the FTA has not precluded these transactions from the benchmarking purview. And there are high chances and likely chances that such transactions shall be cherry picked by the FTA. They shall come back to the taxpayers and ask questions regarding the benchmarking analysis for related party transactions as well as connected person transactions during the FTA audits. We can move to the next slide, please. All right, my friends. Now, as we discussed about corporate tax filing, let's also discuss about the fact that who has to file the corporate tax return. So, my friends, what we've tried to do on this slide is that we've tried to break down the taxable persons into three categories, as you can see on the screen. The first category is resident person, next category is natural persons, and the third category is non-resident person. So, my friends, as we know, let's talk about resident persons first. Resident persons are juridical persons or entities which are incorporated in UAE or in any other country outside UAE but are being effectively managed from the UAE. Now, my friends, this concept is very important. Let's spend a minute about this and talk about the concept of place of effective management. So, my friend, what is place of effective management? I'll give you an example. Let's say we have an automobile company in Germany, but that company is being effectively managed from UAE. Now, I'm sure all of you would be wondering that what is the meaning of this effective management? So, my friends, there can be a case that though the company is incorporated as per the German tax laws and as per the German commercial legal laws in Germany, but let's say the board of directors of this German company are based out of UAE, number one. Number two, there can be a situation where the board meetings of this German company are being held in UAE. Number three, there can be a case that the key strategic decision makers are taking care of all the important decisions for this German company from UAE. If any of these conditions or any other condition which proves that this German company, though incorporated outside UAE, but is being effectively managed from UAE, if this fact is proven, then we say that this German company has a place of effective management in UAE. Now, what happens if you have a place of effective management in UAE, my friends? What happens is that you become subject to corporate tax law in UAE. You have to register yourself for corporate tax, yes, and you have to file your corporate tax return. These are the two implications, my friends, which come into the picture if you have a place of effective management of any foreign company which is being established or incorporated outside UAE but is being effectively managed from UAE. Now, what we have to do here, and it's a recommendation for all of the taxpayers out there in the audience today, that my friends, if you have such situations wherein you have non resident companies outside UAE, and if you feel that you're managing those companies from UAE, then please do a detailed analysis and a detailed fact check to see that where are the decisions of these foreign companies being made from? Are the decisions of these foreign companies being made from UAE? Are these companies getting effectively managed from UAE? So, my friends, that was the first concept for resident persons. If you're a juridical person, yes. If you're an LLC, a free zone entity, a free zone company, all these legal entities, if you fall under the category of juridical persons, then yes, you have to register yourself for corporate tax, which I'm sure all of you would have done by now. And you have to file the corporate tax return within 9 months from the end of your first tax period. That is about resident persons. Now let's talk about non-resident persons. Who are non-resident persons? I'll again explain this concept to you with the help of an example. So, my friends, let's talk about a little bit in detail about permanent establishments. So, my friends, if you're a taxable person and if you have a permanent establishment in UAE, or if you derive state sourced income in UAE, or if you have a nexus in UAE, then it is said that you are a non resident person and you have to register yourself for corporate tax, number one. Number two, you have to file your corporate tax return. Now, what is a permanent establishment? I'm sure all of you out there in the audience are already aware about that. Still, we'll talk about it in a bit. Now, my friends, permanent establishment is a concept which can be dissected into three categories. There can be a fixed place PE, there can be an agency PE, there can be a service PE. Now, what is a fixed place PE? So, my friends, let's say you are a non resident company based outside UAE, but let's say you take a warehouse in UAE, let's say you take an office space in UAE. Let's say your key managerial personnel or some of your employees are deployed in UAE and they are working out of a co-work or out of a hotel. Now, my friends, this co-working space or this hotel or this warehouse, these places can constitute and they can be talked about and concluded to become fixed place permanent establishments in UAE. And how will they become a fixed place PE, my friends? They will become a fixed place PE if the residency clause in the double taxation avoidance agreement between UAE and this other country, if the residency clause is being satisfied. Let's say there is a residency clause in the double taxation avoidance agreement between UAE and country A, wherein it says that if an individual from country A travels to UAE and stays in UAE beyond 180 days, which means beyond 6 months, then it is said that residency clause gets triggered. So, my friends, to see whether a permanent establishment is getting established or not, it is very, very important that we have a look at the double taxation avoidance agreement between UAE and the other country. And there can be a situation wherein the UAE has not signed the double taxation avoidance agreement with the other country. In that situation, also, if the conditions of a permanent establishment, whether fixed place, whether service, whether agency, are getting satisfied, then yes, these permanent establishments are considered as non-resident taxable persons. And if you become a non-resident taxable person, then you have to register yourself for corporate tax and you have to file your corporate tax return. Now that was about fixed place PE. Let's talk about service PE as well as agency PE. So, my friends, if I talk about service PE, like I said, there can be a situation wherein employees are being seconded in UAE beyond a particular time period. If such secondments are there, then yes, because of these secondments or deployments, we say that a service PE is being established. And last but not the least, if I talk about agency PE, there can be a situation wherein we have an agent, which is an exclusive agent for another company, for a principal. And if this agent is taking care of all the negotiations, if this agent is concluding the contracts, if this agent is finding the business, if this agent is signing the contracts on behalf of the principal outside UAE, then we say that an agency PE is getting established. So, my friends, that was about permanent establishments. Now, like I said, there is another situation wherein you can have a nexus or you can be deriving state sourced income in UAE. Let's talk about few examples for this. If I talk about state sourced income, so my friends, there can be a situation wherein, let's say, from port A outside UAE to port B in UAE, if the goods are being transported and if the title of the goods is getting transferred on the port in UAE, then we say that state sourced income clause can be triggered. Why? Because state is UAE, sourced income is any income from, let's say, sale of goods or provision of services which is derived in UAE. So, my friends, we have to be very careful, specifically in relation to third port shipments, number one. Also, in relation to any trading activities wherein goods are being transported through UAE or in a high sea basis, if the title of such goods gets transferred, if the incidence happens in UAE, then there are chances that the clause of state sourced income can get triggered. And last but not the least, if we talk about nexus in the state, so the simplest example for nexus can be that let's say you're a non-resident taxable person outside UAE, but you have taken a commercial license to run certain commercial properties in UAE. In that situation, whatever rental income you get from these commercial properties, those rental incomes constitute that you have a nexus in the state of UAE. And last but not the least, if we talk about natural persons now. Who are natural persons, my friends? As I'm sure all of you know, sole establishments, sole proprietorships, unincorporated partnerships, individuals are considered as natural persons as per the UAE corporate tax law. And if you're a natural person, you must be very careful and you must see that if your turnover exceeds 1 million dirham, from all the activities which you are carrying on in UAE within Jan to December 2024, then yes, you have to register for corporate tax and yes, you have to file your corporate tax return. We can move to the next slide, please. All right, very interesting. That brings us to the first poll question of the day, my friends. And the question is, what is the deadline to file corporate tax return? You have two options on your screen. Your time starts now. All right, my friends, thank you so much for the overwhelming response. And more than 90% of the audience has answered that question correctly, saying that yes, 9 months from the end of the first tax period is the deadline to file corporate tax return. So, like we said, if you have your Gregorian tax period, which is Jan to December 2024, then in your case, the deadline to file corporate tax return shall be 30th September 2025. And we can move to the next slide, please. All right, my friends, like we just discussed, let's talk about the deadline for filing corporate tax return in a greater detail here. So, my friends, not all of us are following the Gregorian tax period. I'm sure many of you in the audience and many of even our clients, we've seen cases wherein the tax period is, let's say, June beginning or let's say July beginning. Then what happens for them? So, my friends, what happens is that let's say your first tax period was 1st June 2023, right? 1st June 2023 onwards, then in that case, you have to file your corporate tax return by 31st December 2024. Why is that so? Now, the law got incepted on 1st June 2023, and what has happened is that in that situation, let's say the deadline as per the FTA first was 30th September 2024. However, they changed the deadline, they pushed it, and the deadline became 31st December 2024. That was the first deadline. Second deadline, if your corporate tax period starts from 1st of July, then your deadline to file return was 31st March 2025. And last but not the least, the most common one is the Gregorian tax period, which many of you would be following, wherein if you're following Jan to December 2024, then the deadline for you to file the corporate tax return shall be 30th September 2025. And my friends, let me also tell you a very important new update there, which has been published by the FTA, which says that in case you have failed to register your company within the deadline as per FTA decision number 3, then in that case, if you've got a penalty because of late registration, which is around 10,000 dirhams, then that penalty will be waived by the FTA. Yes, my friends, please be very careful. If you've gotten a late corporate tax registration penalty, then that penalty can be waived if you file your return within 7 months from the end of your first tax period, which means not by 30th September, but by 31st of July. So in case you've gotten a penalty for late registrations, please be very careful and please see when the return filing you have to do. You have to do it within 7 months from the end of your first tax period. We can move to the next slide, please. All right, my friends. Now let's talk about the corporate tax rates here. Now, as all of you know, the entire UAE market is divided into two categories. We have mainland companies and we have free zone companies. So let's take it simply step by step. In case we have a mainland entity, then what happens? If we have a mainland entity, my friends, then up to 375,000 of our net profit is subject to 0% tax, and over and above 375,000 is subject to 9%. Yes, so in case we are a mainland company, the first 375,000 shall be zero rated. Over and above 375,000 is subject to 9% tax. But we also have certain advantages there, which I'm sure all of you would have gone through by now, is our Article 28 of the law. Now, what does Article 28 talk about? Article 28, my friends, talks about allowability of official nature expenses. Yes, let me explain you simply. Basically, expenses which are wholly and exclusively of business nature and expenses which are wholly and exclusively incurred for official purposes are subject to being allowed under Article 28. But there are also certain expenses, my friends, which are allowed as a deduction with a certain threshold. So let's talk about these expenses also. Now, the first kind of this expense shall be entertainment expense. Yes, I'm sure many of you would be facing that challenge that what should be considered as entertainment expense and what should not be considered as entertainment expense. So, my friends, let me tell you an insight there. Now, let's say you have incurred 100 dirhams for any recreational activity for your clients, suppliers, or any potential customers, clients, or suppliers. So any recreational activity, if you incur, let's say 100 dirhams, then as per corporate tax law, you shall be allowed 50 dirhams as a deduction. Yes, let me repeat that for you. 50% of such entertainment expense which you incur for your existing clients, existing suppliers, potential clients, potential suppliers. If you incur such expenses, then 50% of those expenses shall be allowed to you as a deduction, and the balance 50% shall be disallowed. Point number one. Point number two, where the confusion arises in many of the taxpayers' mind is that what do we do with our staff welfare expenses? So, my friends, whatever expenses you are incurring for your staff welfare shall be allowed as a 100% deduction. Why is that so? Because staff welfare expenses are directly related to your core income generating activity, which is your core official business nature, activity, and purpose. So, any staff welfare expenses shall be 100% allowed. Any entertainment expenses for potential clients, customers, new clients shall be allowed to the extent of 50%. But there are certain situations there which you must analyze carefully, and I'll give you one practical example. Let's say you hold a marketing event to market or campaign the new products which you have launched. And you book a space, or let's say a convention center for that. You pay the rental expense to that convention center. So, what happens to that rental expense? Will that also be allowed 50%? The answer is no. So, my friends, why is the answer no? Any expense which you incur to promote your business activity shall be considered as wholly and exclusively related to your business purpose. So, whatever rental expense you pay to the convention center to have your marketing event shall be allowed as a 100% deduction. Number one. Number two, the important point. Let's say there are suppliers, customers, clients who are coming to attend this marketing event. And you, as the company, as the taxpayer, you sponsor the airfare of these clients, or you sponsor the travel, or you sponsor the accommodation or the transport, right? Which you're using to ferry these clients from point A to point B to the convention center. All these expenses which you incur, which are recreational in nature, shall be considered as entertainment and shall be allowed with a 50% deduction. That was the first expense with the threshold. The second expense with the threshold, my friends, is interest. Yes, I'm sure all of you know. In case of interest expense, 30% of EBITDA restricted to 12 million shall be allowed as interest deduction under corporate tax computation. Now that was about the computation, and that was about the allowances, the disallowances, and the thresholds when we talk about computation of corporate tax. Point number one. Point number two, my friends, let's talk about free zone companies. What happens if you're a free zone person? Now, in case you become a qualifying free zone person, which means if in case you become a zero rated company, then what happens? Then your qualifying income shall be subject to 0% tax. But you also have to check the six conditions as per Article 18, which is very, very important, my friends. To become a qualifying free zone person, you have to check six conditions under Article 18, read along with Cabinet Decision number 100 and Ministerial Decision number 265 to see, are we deriving qualifying income? Are we undertaking a qualifying activity? Or are we passing the de minimis threshold test or not? Yes, my friends, there are six conditions under Article 18. We have to meet the substance. We should have adequate number of employees, adequate assets, adequate operating expenses being incurred from the free zone. We must be undertaking qualifying activity. We must pass the de minimis threshold test. We must maintain a transfer pricing documentation. And last but not the least, our books should be audited and we should not elect to be subject to tax in the corporate tax return. So, my friends, if we satisfy all these six conditions as per Article 18, we check whether our activity is qualifying or not as per Ministerial Decision number 265, read with Cabinet Decision number 100. Then, in that case, we say that we are a qualifying free zone person and our entire income shall be subject to 0%. But let me give you an example there. In case we fail the de minimis test, yes, my friends, in case 5% of the total revenue or 5 million, in case our de minimis threshold is exceeded, which means in case we are doing any non qualifying activity and whatever revenue or income we are getting from the non qualifying activity exceeds the minimum of 5% of total revenue or 5 million, whichever is lower, then in that case, we say that de minimis test is failed, and in that case, our entire revenue, yes, my friends, entire income becomes subject to 9% tax. And in this case, even the threshold benefit of 375,000 is not available, which means the threshold benefit which is available to mainland companies shall not be available to the free zone if it fails the de minimis test. So, my friends, for all the free zone companies out there in the audience today, please be very careful. If you're a free zone company, please be very careful that before you file your corporate tax return, you do a detailed impact study and you do a detailed analysis to check whether you're becoming a qualifying free zone person or not, and you maintain all the corroborative documents in detail to prove whether all the conditions of Article 18, Ministerial Decision 265, Cabinet Decision 100 are being satisfied or not. Now we can move to the next slide, please. All right, my friends. So now in this section, we'll talk about corporate tax compliance, which is the computation. We'll talk about how to calculate corporate tax. We'll talk about the elections as well. Let's move to the next slide. All right, my friends, as you can see on this slide, we've talked about the tax treatment options. We've talked about the deductions which are available, which we just discussed as per Article 28. We also discussed about entertainment expense. We also discussed about interest expense, which has a general interest limitation capping rule as well. Now let's talk about reliefs. So, my friends, there are certain reliefs which are available when you file your corporate tax return. These are business restructuring reliefs, these are small business reliefs, so on and so forth. So, my friends, I'm sure when all of you would have already seen the corporate tax return template, in the corporate tax return template, we have different schedules. Yes, we have different schedules wherein we have to select certain options, which can be elections or reliefs. So, my friends, there can be a situation wherein you want to claim a business restructuring relief, wherein any de-hiving is taking place, any mergers are taking place, assets are getting transferred, right? In that situation, you should check whether you're satisfying the conditions for business restructuring situation or not, and if you're eligible to claim the business restructuring relief. Point number one. Point number two, there can also be a situation wherein you want to avail the election of free zone, which means in case you want to avail the qualifying free zone person benefits, then yes, you have to ensure that you meet all the conditions which we discussed in the previous slide, and you have to elect that you do not want to be subject to tax if you're a free zone company. So, my friends, when you practically open the corporate tax return format, you will see all these schedules which talk about elections, they talk about options, they talk about reliefs. There is another very important election also, my friends, in the corporate tax return, which is about realized and unrealized gains or losses. So, what happens in case of realized and unrealized gains or losses, my friends? You have to see which option are you taking. Are you treating your unrealized gains or losses as it on a realized basis or on an unrealized basis? Depending on that, my friends, you have to select the relevant option in the corporate tax return. We can move to the next slide. All right, my friends. So on this slide, what we've done is we've talked about corporate tax computation. As I just discussed, what is the starting point for starting the corporate tax computation, my friends? That is the profit and loss for the period as per your profit and loss account. Now, which profit and loss figure do we have to take, my friends? So we have to start from EBITDA, which is earning before interest, tax, depreciation, amortization. That shall be the starting point from our books of accounts when we start the computation of corporate tax. In this EBITDA, we have to add the disallowed expenses, which we just discussed. Whatever expenses, let's say for entertainment, the balance 50% shall be disallowed. For interest expense, any expense which is over and above 30% of EBITDA restricted to 12 million, any expense over and above that shall be disallowed. Point number two. Point number three, my friends, whatever expenses you are incurring from your company's business bank account, but those expenses are for personal nature. Let's say you're incurring personal nature expenses for the owners, for the directors, All those expenses, my friends, specifically with relation to, let's say, communication, let's say any telephone expenses, let's say any travel expenses, let's say any fuel costs, right, which pertain to personal nature, all those expenses shall be disallowed. So we have to add back all those expenses here, right? After that, we have to do the necessary adjustments. We shall arrive at our net profit. And out of that net profit, which we just discussed, the first 375,000 shall be subject to 0%, and the balance over and above 375,000 shall be subject to 9% corporate tax. We can move to the next slide, please. All right, my friends. Now, how do we prepare ourselves for corporate tax and transfer pricing filing? This is something which is very important and which we just discussed in the previous slides as well. So let's pay some attention here and let's discuss this here also. Now, my friends, to prepare for corporate tax as well as transfer pricing filing, number one, we must have our trial balance in place. Number two, we need to see whether we are required to get our books of accounts audited or not. Now, my friends, as you know, as per the FTA and as per the law, they have said that if you are a mainland company and if your turnover exceeds 50 million dirhams, then you must get your books of accounts audited. Point number one. Point number two, my friends, there can be a situation wherein, irrespective of the turnover, the licensing authority with which you are registered, your licensing authority, let's say DMCC or Hamria, they request for your audited financial statements on a year-on-year basis, irrespective of the turnover or revenue. I'm again specifying. So please be very careful. In case your licensing authority requests for your financial statements which need to be audited, then you have to get your financial statements audited. And last but not least, if you were to claim the qualifying free zone status, which means if you want to become a zero rated free zone company, in that situation also, it is mandatory for you to get your books of accounts audited, right? So please be very careful and see under which of these categories you fall. Point number one. Point number two, my friends, it's also generally recommended that now, since corporate tax has come, and now since the FTA shall start the scrutinies, FTA audit shall start, they'll request and ask about your ledgers, they'll request and ask about your trial balances, your books of accounts. It is also advisable that irrespective of your turnover, you get your books of accounts audited out of abundant caution so that you have an audited set of books in place so that tomorrow during FTA audit, if any questions are asked by the FTA, then you have conclusive answers for them because you have your books of accounts audited. Now, first was about the financials. The second thing which all of us must be prepared about before we file the corporate tax return is having a complete understanding of our transfer pricing regulation. Yes, my friends, you must carefully analyze your departmental charts. You must carefully analyze your group structures. Why departmental charts and why group structures? Departmental charts, because my friends, you have to identify your key managerial personnel, your people at the top, people who are MDs, directors, owners, shareholders. They can be divisional heads as well, they can be departmental heads as well. And in some situations, my friends, we've practically seen they can be general managers as well. But if these individuals, irrespective of their designation, are taking care of the key strategic decision making of the company, I will repeat, my friends, key strategic decision making. If they're taking care of the key strategic decision making, which means if they're the heads and brains of the company, then my friends, in that case, they shall be considered as connected person as per Article 36 of the law. And whatever remunerations or payouts you're making to these connected persons, they can be fixed, variable, incentives, perquisites. You have to ensure that you do a proper market analysis, which is a detailed benchmarking to see whether you're making arm's length payments to these connected persons or not. Point number one, right? Point number two, you must carefully analyze your group structure. Why? Because from the group structure, you'll identify your related parties. Now, these related parties can be your subsidiaries, can be sister companies, it can be step down subsidiaries, it can be group affiliates across the globe. So, my friends, wherever you have such related parties, wherein more than 50% shareholding you have, or more than 50% voting power, more than 50% share in profits, more than 50% share in net profits, or if you're responsible for appointing the board of directors for any of these affiliates, sister companies, subsidiaries, step down subsidiaries, then, my friends, you shall be considered as related parties as per the FTA. And whatever related party transactions you are having, you must ensure that again you do a detailed benchmarking analysis and disclose these related party transactions in your disclosure details, which is also called as a disclosure form when we file our corporate tax return. So, my friends, please be very careful, specifically with relation to related party transactions as well as connected person transactions, because this aspect of transfer pricing is very, very delicate, and there are high chances that the FTA shall come back after we file our corporate tax return and they shall ask us questions about our related party transactions and about the payments which we are making to our connected person. And last but not the least, we must identify the non-deductible expenses. Like we just discussed, any personal nature expenses, any expenses which are over and above the thresholds which we discussed, let's say entertainment more than 50%, or interest over and above 30% of EBITDA restricted to 12 million. Anything over and above that shall be non-deductible. And if you have any fines and penalties, yes, my friends, any fines and penalties which have been imposed under any statute on your business, on your company, shall be disallowed. Yes. So you must be very careful when you do the detailed analysis of your trial balance to identify your allowed expenses, your expenses which are allowed with the threshold, as well as your disallowed or non-deductible expenses. Point number one. Point number two, for the corporate tax return, we have to be very careful and analyze, like we said, related party transactions, connected person transactions, and we must ensure that we undertake these transactions at arm's length price, which is fair market value. How will we do that? Like we've discussed in multiple webinars before, my friends, we have to use the publicly available databases. Yes, my friends, the FTA has not specified the name of any specific database, but in the transfer pricing guide, which they published in the month of October 2023, I believe, they have categorically said that any publicly available database you can use to find out the arm's length price of your related party transactions as well as your connected person transactions. We can move to the next slide, please. All right, my friends. So on this slide, what we've done is we've tried to talk about the challenges which you may face while you're filing the corporate tax return. So, my friends, there can be situation wherein you have unrecorded adjustments, right? There can be situations wherein the schedules are missing from your books of accounts. There can be a situation wherein there are linking errors in the accounting software which you're using. So, like we said, all these errors you shall identify when you're getting your books of accounts audited. So, my friends, that's why it's very important that you have your trial balance in place, number one. You have a perfect accounting system or accounting software in place for recording all your entries. And number three, irrespective of the threshold, we are advising everybody, irrespective of the threshold, it is advisable that you get your books of accounts audited so that you have audited numbers, audited figures in place, and you have an independent auditor's opinion. It can be qualified, it can be unqualified on your books of accounts. So, number one is that about the final audited financial statement. Last but not the least, my friends, another challenge which you may face while you're filing the corporate tax return can be on the Emara tax portal. Yes, my friends, while filing the returns, we advise all the taxpayers not to wait till the last date. Let's say 30th September is the due date for filing corporate tax return. And in case the Emara tax portal has already opened and right now it is accepting applications for corporate tax returns, even for taxpayers whose deadline is 30th September 2025. So, my friends, it is highly recommended and it is highly advisable that you start filing your corporate tax return. You start filling all the schedules, and it is advisable that you pay your tax and you submit your return and you do not wait till the last moment. Why? Because there can be chances that there can be certain technical glitches or certain downtime on the Amara tax portal at the last moment. So, my friends, all these aspects you must keep in mind. you must see and you must check whether you have your accounting systems in place, whether you've done any necessary adjustments required or not. You have all the supporting corroborative documents in place. You have your invoices, bills, bills of exports, custom bills, debit notes, credit notes, intercompany agreements, HR policies, bonus policies, variable or incentive policies, all these documents in place. You have your board resolutions in place. You have a travel policy, accommodation policy, any annual ticket policy, everything in place so that you know that what expenses will be allowed, what expenses will be disallowed, what is the basis on which you're calculating an expense, and what is the basis on which you're claiming a deduction while calculating your corporate tax. So it is very important that you have your books of accounts, you have your books of accounts supported by supporting documentation, and you identify any gaps well in advance before the corporate tax filing deadline. We can move to the next slide, please. All right, my friends. So now in this section, we'll talk about one of the reliefs which we discussed, and it was a very important relief which we'll discuss in the coming forward slides, is about small business relief. So let's talk about this as we go to our next poll question of the day in the next slide. And my friends, the second poll question is that are natural persons eligible for claiming small business relief? You have 30 seconds to answer. Your time starts now. All right, my friends, thank you so much for the overwhelming response. And majority of the people have answered the question correctly, saying that yes, natural persons are eligible for small business relief. We shall discuss about this in the next slide, please. All right, my friends. So on this slide, what we've tried to do is we've tried to talk about who is eligible for small business regime in UAE. Let's talk about this. So, my friends, when I say small business regime, let me first explain this to you simply. As per the small business relief regime, if your turnover during the Gregorian tax period, which is during Jan to December 2024, if your turnover or revenue of the entire business as a whole does not exceed 3 million dirhams. Yes, my friends, if your turnover or revenue during Jan to December 2024 does not exceed 3 million dirhams, then in that case, you're eligible to claim small business relief, which means you have to file a simplified return and you do not have to pay corporate tax. Yes, you shall become zero rated in case you are eligible for claiming the small business relief. And when we talk about the simplified return, my friends, practically, I'm sure all of you would have seen in the corporate tax return format on the Amara tax portal, there are certain reliefs. The moment we select that our revenue does not exceed 3 million and we are claiming small business relief, the following schedules in the corporate tax return shall not appear for you. Yes, my friends, you shall be filing a simplified corporate tax return, which will be a smaller version of the entire corporate tax return if you're claiming small business relief. Point number one. Now, point number two, who can claim the small business relief? Let me tell you, unincorporated partnerships, individuals, sole establishments, sole proprietorships, which are natural persons. Then, if the revenue or if the turnover or the income derived by such natural persons during Jan to December 2024 exceeds 1 million dirhams, but it does not exceed 3 million dirhams. Yes, my friends, I repeat, for natural persons, if your revenue exceeds 1 million dirhams during Jan to December 2024 from all the possible avenues from which you're getting revenue in UAE, but this revenue does not exceed 3 million, then even as a natural person, you can claim this small business relief. Point number one. Point number two, for juridical persons, it is simple. If you are a juridical person, your revenue during Jan to December 2024 does not exceed 3 million dirhams, then yes, you can claim the small business relief. But there is a catch there, and I'm sure all of you know that, is that the small business relief is available with a sunset clause up to 31st December 2026. Yes, now what will happen after 31st December 2026? The FTA may increase the safe harbor limit of 3 million to, let's say, 5 million, 6 million, 10 million. Or they may say that we are extending the benefit period for giving the small business relief benefit from 31st December 2026 to, let's say, any coming forward period. Let's say 2 more years, 3 more years, 5 more years. But currently, the FTA has not given any clarity on that, and that is still awaited. We can move to the next slide, please. All right, my friends, now this slide is pretty simple. And in this slide, we've talked about the implications of electing for small business relief, which we've already discussed. What happens is that from the administrative purpose and from the compliance purpose, you file a simplified corporate tax return. Why? Because the moment you select that you're electing for small business relief and your revenue does not exceed 83 million, then in that case, the following schedules do not appear. Number one. Number two, if you're claiming small business relief, then you have an option to maintain your books of accounts on a cash basis. Yes, if you're claiming small business relief, my friends, you can also maintain cash basis accounting for financial statements. These two primarily are the main benefits for claiming small business relief. We can move to the next slide, please. All right, my friends. So now in the coming forward section, we'll talk about free zone qualification. We'll talk about Article 18, Ministerial Decision 265, Cabinet Decision 100. We'll talk about the conditions which are to be satisfied to become a zero rated company. We can move to the next slide. All right, my friends. So now on this slide, we've talked about how has the concept of free zones evolved in UAE. Now, this is something which is very interesting. As we all know and we discussed previously, law was announced in Jan 2022, published in the Gazette in October 2022, got effective on 1st of June 2023. Now, what happened after 1st of June 2023, my friends, was that all of us as taxpayers and all the taxpayers in the industry as well, right? Everybody had questions around free zone. What activity would my company be doing to qualify as a zero rated company? What is my qualifying income? What is a non qualifying activity? What is de minimis? So on and so forth. Now, to put an end to all these questions, to address all these questions, the FTA very effectively and pragmatically published two decisions. One was Cabinet Decision 55 and one was Ministerial Decision number 139. Yes, Cabinet Decision 55, Ministerial Decision 139 were published first, my friends. Those decisions were later repealed by the FTA. Yes, Cabinet Decision 55, Ministerial Decision number 139 were repealed by the FTA and they published two new decisions, right? They published Cabinet Decision 100 and Ministerial Decision 265. Now, these two decisions, my friends, form the basis of Article 18. They form the basis of the free zone concept in UAE. Why is that so? Because these decisions concise and talk about qualifying activities, non qualifying income, qualifying incomes, all the activities which shall be considered as qualifying activities, all the activities which shall be considered as excluding activities. All these clarifications and all these descriptions, my friends, are given in Cabinet Decision 100 and Ministerial Decision number 265. And to summarize the entire concept of free zone, my friends, the FTA published a free zone guide in the last year, in the month of May 2024, wherein they concised all the concepts together, the six conditions of Article 18, the conditions laid by Cabinet Decision 100, the principles laid by Ministerial Decision number 265, and it also took into perspective all the concepts which the FTA has covered by the FAQs which the FTA has published. So, my friends, the Free Zone Guide is a very good read and it actually concises and summarizes the entire concept of free zone regulations in UAE. We can move to the next slide, please. All right, my friends, that brings us to the third poll question of the day. And the question is, if a company fails to meet any of the conditions required for becoming a QFZP, for how many years will it lose its QFZP status? You have 30 seconds to answer. Your time starts now. All right, my friends, thank you for answering that question. And more than 75% of the people have answered the question correctly, saying that current year plus subsequent 4 years. So a total period of 5 years is for which we lose the QFZP status, which is current year 2024 and the coming forward 4 years. So in total for 5 years, we lose the qualifying free zone status if we fail to meet all the conditions as per Article 18 read with Cabinet Decision 100 and Ministerial Decision number 265. We can move to the next slide, please. All right, my friends, very interesting. So on this slide, we've talked about the 6 conditions like we've been repeatedly talking about in the webinar today as per Article 18. Let's summarize them together here on this slide. So the first condition, my friends, as per Article 18, to qualify to become a zero-rated company is maintaining adequate substance. Yes, my friends, you must have full-time employees in the free zone company. You must have the licenses issued from the free zone company for these employees. You must have operating expenses being incurred and being disclosed in the books of accounts of your free zone company. You must have adequate assets, which means the title of the assets should be in the name of the free zone company. If you satisfy all these conditions, we say that the adequacy of substance test is met. But my friends, let me tell you there, and I'm sure all of you are practically also facing the concept and the concern, which is the description of the definition of adequacy of substance. So, my friends, adequacy of substance is something which is very, very subjective. It can vary from business to business. So, please analyze your business conditions in detail and please test the adequacy of substance condition in greater detail to see whether you're meeting the first condition, which is adequacy and which is very, very important to qualify as a qualifying free zone person. Second condition, my friends, like we've discussed before, is that we must derive qualifying income. Where is this qualifying income mentioned? It is mentioned in Cabinet Decision number 100. And what are the qualifying activities? It is mentioned in Ministerial Decision number 265. So, my friends, the second condition as per Article 18 is that we must have qualifying income. We must be undertaking qualifying activity. Then, my friends, the other conditions talk about the fact that we should not elect to be subject to tax in the corporate tax return. We must comply with the arm's length principle and we must maintain our transfer pricing documents. So, my friends, please be very careful in case you're a free zone company and in case you want to become a qualifying free zone person, then you must maintain your transfer pricing documentation in place, which means you must do a detailed benchmarking for your related party transactions and for your connected person transactions. Why is that so? Because that is one of the conditions of Article 18. To become a zero rated company, you have to do benchmarking that is mandatory for you. Last but not the least, like we discussed, you must maintain audited financial statements irrespective of the turnover or revenue of your free zone company. And you must satisfy the de minimis test, which means that if you're having any non qualifying income from any non qualifying activity, then in that case, that should not exceed 5% of your total revenue or 5 million, whichever is lower. Let's move to the next slide, please. All right. So, my friends, after the important small business relief as well as the free zone concept, now we'll talk about transfer pricing documentation. We'll talk about what is transfer pricing, on who does it apply, what is mandatory, what is optional, what documents are to be maintained. We can move to the next slide, please. So, my friends, to start off with, let's talk about the concept of transfer pricing. Now, as all of us know, the UAE has aligned its corporate tax law and the transfer pricing principles with the OECD framework. Yes, my friends, the UAE has categorically said that we are complying with the OECD framework for transfer pricing. So, my friends, we have a concept of related parties, we have a concept of connected persons, and we have a concept of arm's length principle. Why is that so? Because, see, OECD talks about arm's length principle for associated enterprises, which are related party transactions. But we should be very mindful here. Though the FTA is complying with the OECD, but the OECD does not talk about connected persons. Yes, my friends, the concept of connected persons has been specifically brought about by the FTA in UAE, and the primal reason for that can be family foundations being present. It can be that individuals are wholly and solely involved in the business operations, and because of the remunerations which are being drawn from the businesses by these key managerial personnel. Now, to summarize the concept of transfer pricing, as we said, the transfer pricing regulations in UAE have their basis or genesis in the OECD, and the transfer pricing regulations in UAE are covered under Article 34, 35, 36, which talks about arm's length pricing, related party transactions, connected person transactions, and exercising significant control over the business. Yes, my friends. After that, let me tell you, the transfer pricing concept in UAE also says that it's not only applicable on cross-border transactions, but also on domestic related party transactions. So, my friends, in case you're a mainland company and you have a sister affiliate or a subsidiary which is a free zone, or you have two entities under common ownership in UAE, can be mainland, free zone, or free zone, free zone. Any of these companies, if you have common ownership, common control, any of the conditions of Article 34 are getting satisfied, then yes, any transactions you have, even between these domestic companies, shall be subject to transfer pricing regulation. Yes, my friends, and the transfer pricing concept is applicable not only on mainland companies but also on free zone companies. We can move to the next slide, please. All right, that brings us to the fourth poll question of the day, my friends. And the question is: are all companies required to meet transfer pricing documentation compliance of a master file and local file? You have 30 seconds to answer. Your time starts now. All right, my friend, thank you so much for answering that. And I believe there is some confusion in the audience because 60% of the people have answered the question correctly, saying that no, not all companies are required to meet transfer pricing documentation requirements for master file and local file. So, my friends, we'll discuss about the concept in greater detail as we move to the next slide. All right, my friends. So, as we were discussing at the beginning of the webinar today itself, is that when we talk about transfer pricing, there are certain documentation requirements which are mandatory, and there are certain documentation requirements which are optional. Now, let's talk about the mandatory ones first. Now, the mandatory one is the transfer pricing disclosure details. Yes, my friend, it is mandatory when we are filling a corporate tax return. We have to, and yes, I reiterate, we must and we have to disclose our related party transactions, connected person transactions, arm's length price of those, the most appropriate method which we are selecting for benchmarking those transactions in the schedule for disclosure in our corporate tax return. This schedule we also call as the transfer pricing disclosure form. So, my friends, irrespective of your revenue, irrespective of your turnover, transfer pricing disclosure details are something which are mandatory to be filled by all the taxpayers in the corporate tax return. So, my friends, TP disclosure is mandatory. Now, what do we have to do to ensure that we do the correct disclosure in the TP disclosure? Like I said, we have to identify our related party transactions. How will we do that? We have to look at the shareholding structure, the entire group structure to identify our related party transactions. We must do a detailed check of our departmental chart to see that who are the key managerial personnel. So we have to identify related party transactions. We have to identify connected person transactions. We must have an in-house transfer pricing policy in place to see that what are the transactions, with which entity are we having, with which individual are we doing payments for any connected person's payout, which can be fixed, variable, perquisites, any benefits. And we must understand that how are we benchmarking these transactions as per arm's length, as per market standards? Which method are we using? What are the supporting documents which we are maintaining? Do we have agreements in place? Do we have debit notes, credit notes, invoices? Specifically, these relate to related party transactions. Similarly, for connected person transactions, are we having the employment contracts in place? Are we having the proper visa details in place? Are we doing the correct computation for gratuities, correct computation for any benefits? And are these benefits and the remunerations and payouts to these connected persons, are these at market value as per the general fair market value, which is, are these at arm's length price when we do the benchmarking or not? So, my friends, to ensure that we do the correct disclosure details of our related party transactions and connected person transactions in our corporate tax return, we must ensure that we do a detailed benchmarking analysis. We can use any of the publicly available databases to find out the arm's length price for these kind of transactions. We can move to the next slide, please. Now, my friends, moving on from the mandatory requirement, let's talk about the optional requirement. Now, the optional requirement is the local file and the master file. Now, when is the requirement for local file and master file coming in the picture? When do we have to maintain, prepare, and file the local file and the master file? So, my friends, in case you're a UAE entity and if your turnover during 2024 exceeds 200 million dirhams at an entity level in UAE, number one, or in case you're a part of a multinational enterprise group. Yes. And if the turnover of the multinational enterprise group exceeds 750 million euros, yes. If it exceeds 750 million euros, which is nothing but close to 3.15 billion dirhams. Yes, my friends, if at a local entity level you exceed 200 million dirhams turnover, or if you're a part of a multinational enterprise group and the consolidated group turnover in your case exceeds 3.15 billion dirhams, then for the local entity in UAE, you have to maintain local file. And for the parent entity of the group as a whole, the master file has to be maintained. Now, this is an either or condition. But let's talk about what are the components of this local file and master file. Now, my friends, on this slide, we've talked about the components of a local file. Now, as we know, the FTA, like I said, is complying with the OECD. And the FTA, while it's complying with the OECD, is also complying with the BEPS framework of the OECD. Now, as we all know, as per the BEPS Action Plan 13, yes, BEPS Action Plan 13, my friends, there is a concept of three-tier documentation, which talks about local file, master file, country by country report. Now, as per BEPS Action Plan 13, local file, my friends, is a transfer pricing document or a transfer pricing study to be maintained by the local entity in UAE. Now, it will capture information about the local entity. It will capture information about the group if in case the local entity is part of a group. It will capture the FAR analysis, which is very, very important. We do a detailed functional asset and risk analysis. It will capture the benchmarking in the economic analysis section, and it will capture the tested party margins. And at the end of the local file, we give a conclusion whether our tested party margins are within the arm's length range or not. That is about the local file. Let's move to the next slide and we'll talk about the master file as well. So, my friends, as we presented on this slide, master file is the consolidation of the group's details. It is the blueprint of the group as a whole. In the master file, we talk about the entire group's organizational structure. We talk about the businesses of all the affiliates together. We talk about the intangibles, which entity holds which intangible in the group, which entity is responsible for what aspect of the DEMPE function, how are the taxes being aligned by all the entities, and what are the intercompany financial activities, which can be intercompany loans, which are taking place between all these group affiliates together. All these details, my friends, even related to the value drivers, profit drivers with respect to the group as a whole, are covered under master file. We can move to the next slide, please. And yes, my friends, on this slide, we've talked a little bit about the compliance obligations for small business relief, like we discussed. If in case your revenue does not exceed 3 million, then you can claim small business relief. Natural persons more than 1 million, but less than 3 million, you can claim SBR. Juridical persons, if your revenue does not exceed 3 million, you can claim SBR. You have to file a simplified return, but the only catch is that as if you're claiming SBR, the law has said that you're exempted from maintaining transfer pricing documents, but they have also said that still the FTA has the liberty and the FTA has the discretion to come to you, even if you're a small business relief claiming company, to ask about your related party transactions, your connected person transactions. So it has not precluded SBR claiming companies from maintaining transfer pricing documents. So, my friends, even if you're claiming the small business relief, it is advisable that you try and do a benchmarking for your related party transactions and for your connected persons payouts. We can move to the next slide, please. All right, my friends, in this section, we'll talk about the issues and concerns which can come up when you're filing your corporate tax return and when you're doing your corporate tax compliances. We can move to the next slide. All right. That also brings us to the fifth poll question of the day, my friends. And the question is, should the transactions between related parties be in compliance with arm's length price? You have 30 seconds to answer. Your time starts now. All right, everybody. Thank you so much for answering that question correctly. And more than 90% of the people have answered that question correctly, saying that yes, transactions between related parties need to be compliant with arm's length price as per Article 34 of the law. We can move to the next slide, please. All right, my friends. Now, in this section, let's talk about the issues and concerns which can come up. Like we discussed for transfer pricing, there are chances that the FTA can approach the taxpayers after the filing and ask about how has the arm's length price been computed. They can ask about the related parties, connected person transactions, how is the benchmarking being done. So please be very careful for transfer pricing and please do detailed benchmarking analysis for your related parties and connected person transactions. We can move to the next slide, please. All right, my friends, and taking forward from transfer pricing benchmarking, we have to be very careful when we select our most appropriate method to benchmark the transactions. We should see whether we are finding comparable data from the databases or not. We must undertake detailed FAR analysis to see and to arrive at the correct characterization of an entity before we do the benchmarking. And we must compute the tested party margins first and compare the tested party margins on an entity level basis with the comparable margins as well. Number one. Number two, for related party transactions, we must do a transaction by transaction analysis for benchmarking. And my friends, with that, we've come to an end of today's session. And I hand over to Nirmeen and we can go forward and take the question and answers round as well. Thank you so much.
Thank you, Ms. Aditi, for providing such an insightful and engaging session. We now move to the Q&A segment. But before we proceed, we'd like to let you know that the webinar feedback section is now live. We would appreciate if our audience could take a moment to share their valuable feedback. Additionally, we also request you to leave us a review on Google by simply scanning the QR code displayed on your screen. Your feedback is important to us. Now we invite Mr. Miller and Ms. Aditi to address the question from our audience.
Thank you, Narmeen. We have quite a few questions for this topic. So let's quickly get to it. The first question we have is from Mr. Joel. We filed the tax return, but we paid it late. Will we still be penalized for that?
Thank you, Mr. Joel, for that question. Now, in case you file your corporate tax return but you've not paid the tax yet, then yes, you shall be penalized because, Mr. Joel, it is advised that at the time when you're filing your corporate tax return, let's say your due date is 30th of September. It is advised that you file it by before that, let's say 26th, 27th, 28th of September, and before 30th of September, you already pay your tax liability. In case you pay your tax liability after the due date, then yes, there are chances that the FTA shall penalize your company in that case. I'll also invite Milan to share his practical experience as we've been filing corporate tax returns for the past 2, 3 months now.
Rightly said, Aditi. For example, if you owe 100,000 to the FTA as the corporate tax liability and pay a month late, you'll be still paying around 1,067 extra, and it keeps adding up. So it's better to plan in advance before the due date to avoid any potential penalties.
Rightly said, Milan. We can move to the next question, please.
Next question we have from Kishore. We are a free zone company. Do we automatically get 0% corporate tax?
Thank you, Mr. Kishore, for that question. Well, the question is very simple, but the answer is not that simple, Mr. Kishore. Now, the thing is that if you are a free zone company, then there is no automatic benefit of your company becoming zero rated. You must satisfy all the conditions of Article 18. You must submit all the details in your corporate tax return, and you must test whether you're satisfying each and every condition of Article 18 read with, as we discussed, Cabinet Decision 100 for qualifying incomes, Ministerial Decision number 265 for qualifying activities. You must see whether your activities are qualifying in nature, whether your income streams are qualifying in nature, and whether you're satisfying each and every six of the six condition of Article 18. Only then will you be able to get the qualifying free zone person benefit. So yes, before you file your corporate tax return, please do a detailed check to see whether you're becoming a zero rated company or not. What do you think, Milan? How are we facing this and how are we addressing this practically in our corporate tax returns on the portal?
Yes, Aditi. For qualifying free zone person, we have to check all the six conditions. We have also certain clients, they're trying to claim that they are qualifying free zone, but when we assess carefully, they might not be meeting certain conditions. And it's also important to know that if during the FTA audit, if the conditions are not met, it will be ceasing to be a qualifying free zone person for that period as well as the subsequent four periods. So it is better to check all the conditions thoroughly.
Rightly said, Milan. And yes, Mr. Kishore, if you lose your benefit, you shall lose it for not just for 2024, but the coming forward four periods as well. So please be very careful when you do your qualifying free zone testing.
Next question we have from Mr. Luke. What is this TP disclosure form and what exactly we put in it?
Thank you, Mr. Luke, for that question. Now, like I said, transfer pricing disclosure form. When you open your corporate tax return, in the corporate tax return, there is a schedule which talks about disclosure details. Now, this schedule talks about related party transactions, connected person transactions, arm's length price of these transactions. So, Mr. Luke, when you open your corporate tax return, you have to fill these details, and yes, it is mandatory to be filled for the related party transactions as well as for the connected person transactions. And in the schedule, the first two questions which the FTA asks is that for your related party transactions, is the quantum exceeding 40 million? Number one. And for the connected person transactions, is the quantum exceeding 500,000? Number two. If you select yes, then the subsequent schedules open, and in that you have to fill the transaction details, the book value, as well as the arm's length price, and any necessary adjustments which you are making, along with the most appropriate method. But Mr. Luke, having said that, though the corporate tax return has given these thresholds, but the law has also not categorically mentioned that if the value of your related party transactions is less than 40 million and if your connected person transactions is less than 500,000, they will not ask for benchmarking. So, irrespective of the value, it is advisable that you do a benchmarking and you have your arm's length study ready before you file your corporate tax return, not just for related party transactions, Mr. Luke, but also for connected person transactions because the law has not precluded these transactions from benchmarking analysis. And they have said in Article 34 that for related party transactions as well as for connected person transactions, arm's length principle, which means benchmarking analysis, has to be done. What do you think about that, Milan, practically?
Yes, Aditi, as you mentioned, it is we can think it of as a summary of declaration to the FTA regarding who are your related parties, who are your connected persons, what type of method you are using for benchmarking, the nature of transactions, the values, etc. So basically, the idea is to help the FTA assess whether the arm's length are in the range or not. Moving on to the next question we have from Nadia. Is small business relief available every year? And what if we had losses this year?
So, Ms. Nadia, thank you for that question. Now, see, small business relief is available up till 31st December 2026. Number one. Number two, you have to check your top line, which is the revenue which is being derived from the business. If the revenue does not exceed 3 million, then you can claim small business relief. The law does not talk about the profitability or the loss situation. Anyhow, you will be paying zero tax, right? So irrespective of profit or loss, you have to check your revenue. If it doesn't exceed 3 million, you can claim SPR. What do you think about that, Milan?
Yes, just a point to add, if the company is qualifying free zone person or part of a M&E group, then this won't be applicable. And also we have to remember that you can't carry forward tax losses in which in which for which in SBR is selected the years. Next question we have from Andrea. What if I forget to update my taxable person profile?
So, Miss Andrea, number one, see, it's very important that you have your taxable person profile amended, up to dated, and if in case there are any changes, then those changes have to be taken care of in the taxable person profile before you file your corporate tax return. Because if that is not done, then yes, that can be questioned by the FTA. What do you think about that?
Yes, as per the tax procedures law, we must notify the FTA within 20 business days if there are any changes to any ownership structure, license, address, etc. And it's also important to note that before the city filing, these details should be reflected in the portal to ensure their accuracy. Next question we have from Mr. Joseph. Um, let's take one more question as we have time constraint here. Can we use UAE global benchmark? Can we use global benchmark for TP? And what if we don't have the UAE comparables?
Hi, Mr. Joseph, and thank you for that question. So, see, global benchmark is not advisable to be used because in the transfer pricing guide published by the FTA in October 2023, they talked about the fact that local comparables, if not local, then regional comparables, and if not regional, then we move to the rest of the world. So, Mr. Joseph, it is advisable that local comparables are used. Global benchmark shall not be accepted by the FTA. Why? Because that shall not be having number one UAE comparables, number two GCC comparables. So that will not be like a perfect fit to benchmark your related party transactions. What do you think about that?
Yes, as you said, it's better to have that criteria rational. It should be properly documented and make sure the method still reflects the arm's length price according to the UAE operations. I hope that answered the question, Joseph. And with that, I hand it back over to Nermeen to conclude the webinar.
Thank you, Mr. Milan and Ms. Aditi, for delivering such an informative and engaging session. A big thank you to everyone in the audience for joining us today and contributing to this experience. Your presence and active participation have truly made this session valuable and impactful. We look forward to connecting with you again in our future webinars. Until then, if you have any further queries regarding excise, VAT, corporate tax, please feel free to drop us an email or give us a call. The contact details are on the screen. Thank you once again.